We'll revise them for you, but let's invite our market master at this juncture. Pramod Gubbi, the Director Institutional Sales at Ambit Capital, joins us now from Singapore. Morning, Pramod. Always a pleasure having you with us. One of the characteristics of this market has been this extraordinary mid-cap outperformance. Year to date, a huge 12% gain in the CNX mid-cap index itself. But individual performers are much, much better and much more sparkling. Do you think that this rally in the mid-caps, in this bottom-up stock picking, has a lot more to go?
Yeah, again, when you talk about bottom-up stock picking, it all depends on the specific stocks that you're looking at. Once you broad base it and generalize it, you take away the exact concept of a stock picking. Having said that, we've always maintained the view that in India has been largely a bottom-up market for long. So irrespective of what's happening to the broader economy, trickling down to the large cap index, which are more correlated to the economy, there are several high quality businesses in the mid and small cap space run by high quality promoters with capital discipline in niche areas, and which is why I guess they are a bit immune to the broader economy, that they can do well irrespective of the macro environment. Those stories will always remain, but having said that, I think I must admit those sort of stories are becoming few and far between as compared to what we used to see 3-4 years ago.
Oh.
Okay. Pramod, hi, good morning. Good to see you in. We wake up this morning with some news flow from some of the Fed officials, especially the president of the Atlanta Fed, Dennis Lockhart, where he said that he supports a rate hike from the Fed in the month of September. So now it seems more likely that we could perhaps get the first Fed rate hike in the month of September itself. When that comes through, what kind of an impact would you see on emerging markets like India?
I think generally emerging markets will see some sort of turbulence, particularly some countries where currencies have held up despite news of this Fed rate hike being imminent. Those currencies will suffer more. India has also seen the rupee fairly stable, but I think the rupee has a couple of things going its way, partly because the Indian debt market is not that large compared to some of the other emerging markets where a potential pullback or outflows could cause a hit on the currency. But nonetheless, we are not totally immune. So expect some volatility around that event.
Okay. Any takeaways from yesterday's credit policy at all?
I think it was pretty much in line with what we were expecting. I think a couple of things to watch out for. Clearly the RBI highlighted 3 aspects. One is the pickup in inflationary expectations. The other is the possible Fed rate hike next month, and thirdly, the transmission of monetary policy. I think that the first one needs to be more deeply understood. I don't think there isn't much understanding at this stage. Yes, there is a pickup in prices of pulses and protein-rich foods, but there's also a significant increase in the area allocated for pulses in general. At some stage during the next harvest season, that should start trickling down to putting prices back. But we still need to understand where those pickup in inflationary expectations are. On the second aspect we just discussed, I think it is quite prudent. The RBI has been quite open in suggesting that the June cut was more front-loaded. To that extent, it makes sense to wait for September event to pass. The third one is more interesting. I think monetary policy transmission clearly hasn't been in line with what the governor would have expected ideally. And the event of last Friday, which is the capital infusion into some of the PSU banks, might just hasten that a bit. That's something that we need to watch out for. Now that the money will come into the banks need to deploy that. There is a need to increase lending where demand isn't much. So one of the obvious things could be further cuts to base rates of banks, which could prompt the RBI to say, yes, the transmission is indeed happening and maybe there's scope for one more cut.
Okay. So talking about PSU banks, that actually has been the big theme in the last 1 week, Pramod. Do you think that an investor or a long-term viewer of the market should start increasing allocation into PSU banks, or is this just a trading move that we're seeing?
It's definitely incrementally positive. I wouldn't say it has changed the investment case for PSU banks structurally just yet. It is positive to the extent that it has more capital to be able to drive credit growth more. But I think the more meaningful change could be one is more cyclical, which is how do you deal with the current asset quality issues? Do you simply grow out of them, grow in areas like retail, housing, which they've been doing for the past few quarters, at such a pace that these asset quality issues become much smaller as part of your whole book? And the second is more structural in nature in terms of reforming the governance structures of some of these PSU banks, the way that they are run, the incentive structures for management to be able to compete with the private sector banks. Unless and until we see two of these, it remains a trading play at best.
Okay. Pramod, if you didn't look year to date, but looked from, say, April to date, actually India is an outperforming story, especially compared to most emerging markets. What are you selling as the India story? Is it capital goods? Is it private sector banks? Or is it the old favorites, you know, IT, pharma?
I think it all depends on the horizon you're looking at. If we look at a 3 to 5 year horizon, which is a large part of our client base, then I guess all aspects of the story look interesting. More so consumption and investment, not so much exports. But however, for the shorter term, I think the domestic economy is clearly decelerating because of some of the structural reforms that are taking place, which inevitably have a short-term negative impact, both in terms of rural consumption as well as real estate and construction being a drag on both consumption and investment in general. To that extent, I think earnings numbers could remain across sectors quite weak. The only surprise could be in consumption, where we are seeing some of the changes in the subsidy mechanism, cash transfers and so on, actually giving money in the hands of the bottom of the pyramid consumer for the first time ever. And sooner or later, they're going to start spending on some staples, which could see a pickup in earnings and definitely ratings of some of these stocks. So consumer possibly, and external looking pharma and IT for the short term. But for the longer term, I think both consumption and investment should do well.
Okay, so pharma and IT stocks for the shorter term is what you recommend. But what about many of these companies that are big beneficiaries of falling crude prices? So the tire stocks, paint stocks, oil marketing companies. We've seen, you know, new highs being hit every day over there. What pockets are you interested in?
I think deflation has both effects. I think in a situation where you are seeing demand picking up, where you have the bargaining power to retain much of the benefits of the input costs coming off, could help in margin expansion. But at this stage, from what we see, there is a lack of demand pickup in most aspects of the economy. So I don't see many of these companies actually being able to retain most of the input cost benefits. In fact, a number of them will have to take price cuts to push demand further, which is obviously the right thing to do in such an environment. So the margin expansion the market seems to be expecting might remain elusive for a while.
You know, Pramod, one of the things we keep picking up from domestic fund managers is the rush of India money and savings that is now finding its way into stock markets and other financial assets. The non-performance of gold and real estate in particular is turning out to be a manna from heaven for the DIIs, the domestic investors. How do you gauge this force? Is this liquidity strong enough to surprise us in terms of Nifty levels and stock levels in the next 6 months, 12 months?
I think it already has, given the sort of macroeconomic indicators and corporate earnings that we've seen. I guess the Nifty should have been 8-10% lower than the current levels, but for this sort of flows that we've seen.
Okay.
And it's definitely structurally positive for the market. We lower our reliance on foreign money, which can be volatile, given number of global factors which are not under our control. I think the shift of Indian savings from physical savings to financial savings seems to be happening finally. Hopefully this is for good, in which case it's definitely good for the financial system in general, be it the banking system or capital markets. We've also been aided by June foreign flows also picking up. Thankfully, the The turbulence in China also has meant that whatever little money that left India towards China has come back. And at least where we stand, there isn't much competition to India as an attractive investment destination. So while we have weakness on the economic front, I think flows-wise, technicals-wise, we have some support, which is what making the market sway sideways.
You were speaking about weakness in the economy and that the deceleration can remain with us for some time. Most analysts we talk on, several analysts are still looking at probably single-digit earnings growth, probably 7% or thereabouts this year. What would your own earnings estimate be for your sample group of companies, and which is that quarter where we can see a seminal improvement in earnings?
I think it's tough to call. Right now we are close to about 7 to 9%. I guess we are closer to the bottom of the estimate spectrum. But after this earnings season, I think our analysts are taking a harder look. Perhaps the risks are further to the downside. Now, the more important question is, when do we see the bottom of this? That's been really hard to call. We have our ears to the ground. We try and be as ahead of the market as possible. But what I can say is certainly not in the next 2 quarters. Perhaps, hopefully, in the last quarter of this fiscal year, if not beyond that.
Okay. Thank you very much, Pramod, for joining us with all those thoughts, the macro perspective, as well as the sectors that you are watching. Well, that's the word from Ambit Capital, still preferring to the IT and the pharma stocks in the near term and betting on economy proxies for the longer term. Well, we were telling you about